Hello, Soundarya here. As we have already discussed about the types of markets, primary market and secondary market. In this video, let's discuss in detail about the primary market. Let's recall what is the primary market. A primary market is a form of capital market wherein new securities are sold by the companies for the very first time to the investors to raise funds. Prior to IPO, a company is considered to be private with lesser number of shareholders. After IPO, the issuing company becomes a publicly listed company on a recognized stock exchange. So, IPO is also known as going public. Types of issues in primary market. Type 1, public issue. Public issue is further classified into IPO and FPO. IPO is the first public issue of the shares of a private company that is going public. And FPO is the second or subsequent public issue of the shares of an already listed public company. Type 2, rights issue. Rights issue is an offer to the company's existing shareholders to buy further new shares of the company at a discount rate. Type 3, bonus issue. Company issues fully paid additional shares to the company's existing shareholders for free. This issue is made from company's free reserves and securities premium. Type 4, private placement. When a company's stocks and bonds are directly sold to the selected group of people, say 50 to 200 people called private investors or institutions, instead of offering the same to the general public, it's called private placement. Private placement is further classified into preferential issue, qualified institutional placement, and institutional placement program. Preferential issue. It is an issue of shares or convertible securities by listed companies to selected group of people, which is neither a rights issue nor a public issue. Qualified institutional placement. When a company which is already listed in the stock exchange issues shares or debentures or any kind of securities which are convertible in nature to qualified institutional buyers, it's called qualified institutional placement. Qualified institutional buyers include mutual funds, venture capital funds, scheduled commercial banks, state industrial development corporations, national investment funds, insurance funds, provident funds, pension funds, etc. Institutional Placement Program or IPP. The Institutional Placement Program allows the promoters of a listed company to either issue fresh equity or sell their holdings by up to 10% of the total equity, but only to the qualified institutional buyers. Let's understand how it happens. The first step is selecting a team of underwriters or investment banks to start the process. This team will study company's current financial position and an underwriting agreement will be signed, which will have the details of the deal. Underwriters are the financial specialists who work closely with the issuing body to determine the initial offering price of the securities. Underwriters buy securities from the issuer and sell the securities to the investors via their distribution network. They provide a guarantee to the firm to sell a specific quantity of stock. And say, if an underwriter fails to convince a prospective investor to buy this many shares, he must buy the surplus himself. Step 2. Registration with Securities Exchange Commission. The company and the underwriters together file this registration statement, which comprises of declaration how the company is going to utilize the funds it raised from the IPO. Drafting red herring prospectus. It's called red herring document because the first page of the prospectus contains a warning which states that this is not the final prospectus and it doesn't include the complete information about the issue. It is only circulated to generate interest among the investors about the issue. Once the offer of the securities is closed, a final prospectus stating details and the complete information which is incomplete in the red herring prospectus, shall be filed with the SEBI. Going on a roadshow. The executives of the company travel around the country marketing about the upcoming IPO. IPO is priced based on whether the company wants to float a fixed price or book building issue. The price or price band is fixed. A book building issue will have a price band within which an investor can bid. Number of shares that will be sold is decided, and the company should also decide the stock exchange where it is going to list the shares. On a planned date, the prospectus and the application forms are made available to the public offline and online. People can get the forms from any designated banks or broker firms. Once they fill their details, they can submit them with a check, or they can submit it online as well. SEBI has fixed a period of availability of an IPO, which is usually 5 working days. After the IPO price is finalized, the stakeholders and the underwriters work together to decide how many shares will an investor receive. Investors usually get full securities unless it is oversubscribed. The shares are credited to their demat account, and the refund is given if the shares are oversubscribed. Thanks for watching. If you like this video, give us a thumbs up and share it with your friends, and subscribe to our channel.